In the first 3 months of 2026, Japanese investors sold $29.6 billion dollars of American debt. Treasuries, agency bonds, municipal paper, the largest quarterly sale in 4 years. For 2 decades, Japan was the quiet reason the rest of the world could borrow cheaply. Now it's bringing its money home. That matters more than it sounds because every country on earth is in debt. The United States now owes over $39.6 trillion and is climbing toward 40. The European Union carries a record 15 euros 7 trillion. Japan owes more than twice the size of its own economy. Even oil-rich Saudi Arabia and export giants like Germany and China carry enormous sums, which leaves a question almost nobody asks until the money starts moving. If everybody owes, who exactly is owed? Follow the chain of creditors far enough and you find something uncomfortable. The world doesn't owe money to anyone in particular. It owes it to itself. That doesn't mean everyone inside the loop is standing on the same side of it. The whole arrangement started with a shortage of gold. In 1694, England was at war with France and running out of money. The king turned to a syndicate of London merchants, who offered a deal. They would lend the crown £1.2 million, and in exchange, they would receive a permanent stream of interest backed by future taxes, plus a charter to run the new institution built to manage it. That institution was the Bank of England. The state could now spend money it did not yet have, and the lenders received something arguably better than repayment, a promise from a government that could itself be bought and sold. England wasn't the inventor here. Dutch merchants had been trading government debt on an open exchange for close to a century already. England borrowed the model and scaled it. France copied it. The newly independent United States adopted it to pay for its revolution. Somewhere in that century, national debt stopped being evidence of failure and became a measure of credibility. Empires had conquered territory to take gold, now they issued bonds and collected interest instead. 3 centuries later, the numbers are bigger, and the structure is identical. Global debt, governments, companies, households together, reached nearly $353 trillion in the first quarter of 2026, roughly 3 times everything the world produces in a year. So who is holding the other end of the rope? The rest of it circles. The Treasury issues bonds. American banks and funds buy them. The Federal Reserve buys some too, creating new dollars to do it. American taxpayers cover the interest, and that interest lands back in American retirement accounts. The debt is real. So is the interest. The creditor is mostly the country itself. The same circle runs well beyond America. Central banks and sovereign wealth funds across Asia and the Gulf hold Western bonds. Western governments fund the IMF and the World Bank, which lend to developing economies, which park their reserves right back into the same handful of Western currencies and bonds. Every country holds someone else's IOU, secured by another IOU. It's a poker table where every player borrowed their chips from the player sitting beside them, and the only rule keeping the game alive is that nobody stands up. For most of that history, there was a hard limit on the trick. Under the Bretton Woods system, the dollar was tied to gold at $35 an ounce, and every other major currency was tied to the dollar. Debt could grow, but only so far because the metal in the vault was finite. By 1971, the arithmetic had broken. Foreign governments were holding more dollars than America held gold, and France had already started shipping its dollars back across the Atlantic and asking for the metal instead. So on a Sunday evening in August 1971, Richard Nixon went on television and closed the window. It was announced as temporary, it was never reversed. From that night on, money was backed by nothing except the promise of the government issuing it, which meant debt no longer had a ceiling made of metal. From then on, the ceiling was belief. Belief is a strange kind of collateral, because it holds completely right up until it doesn't. And central banks aren't only managing this system, they're manufacturing it. Every time the Federal Reserve or the European Central Bank buys government bonds, it creates new money to do it. One balance sheet's liability becomes another's asset. There is no such thing as debt-free money. We've watched what happens when the belief cracks. In 2010, Greece could no longer refinance its debt at a price it could afford. Yields spiked, the IMF and the European Central Bank stepped in, and the rescue arrived wrapped in austerity, tax rises, spending cuts, unemployment above 20% for years. Pensions were cut and then cut again. A generation of Greek graduates left the country and never came back. Argentina has defaulted so many times that debt became a kind of national inheritance. And in 2022, Sri Lanka simply ran out of foreign currency. Fuel queues stretched for days. Schools shut because there was no fuel to get teachers to them. Blackouts moved through the country block by block. Within months, protesters were swimming in the president's pool and the president had left the country. The agencies that grade all this trust aren't only watching small economies. On the 16th of May, 2025, Moody's stripped the United States of its last perfect credit rating, cutting it from AAA to AA1. S&P had already downgraded America back in 2011. Fitch followed in 2023. Moody's was the last holdout. It had given the United States a perfect score since 1917, through two world wars, the Depression, and every debt ceiling standoff since. All three agencies gave nearly identical reasons: debt climbing, deficits widening, and a political system that keeps postponing the argument instead of settling it. The bill for eroding confidence is measured in cash. Net interest on the federal debt hit $970 billion in fiscal 2025. This year it passes a trillion. That's about $20 billion a week, close to $3 billion a day. More than the Pentagon, more than Medicaid. It has now passed gross Medicare spending too, leaving Social Security as the only line in the federal budget that costs more. Split across the country, the gross figure comes to around $118 zero of debt per person, close to $300 zero per household, and a roughly $8,000 a year in interest alone, whether you have ever bought a bond or not. And that's before the crowd out. Interest now eats about 18.5% of every dollar the federal government collects in tax. That is a record, higher than any year since the series began in 1940 and past the old peak set in 1991. Every point of it is a point not spent on roads or research or the response to whatever the next crisis turns out to be. Nothing was cut to make room for it. It simply arrived. The bill for decisions made years earlier. And still the machine doesn't stop because it was never built to. Sovereign debt in the 21st century isn't designed to be repaid, it's designed to be rolled over. A household is expected to pay down principal. A government treats debt like a subscription, issuing new bonds to retire the old ones, a process economists call refinancing. The interest is the point. And the rent is being repriced. The OECD counted a record $17 trillion of government borrowing across its member countries in 2025, heading toward $18 trillion this year. Most of that borrowing buys nothing new. It replaces debt that already exists. Roughly a third of all outstanding fixed-rate government debt matures between now and 2028, and almost all of it was issued when borrowing was cheap. 10-year yields have been running about 2 percentage points above the bonds that are coming due, so the higher cost never arrives as a single shock. It arrives in installments every time a bond rolls over, for years. Which brings us back to Japan. For 30 years, Japan was the case study for infinite rollover. Near zero interest rates, a debt more than twice the size of its economy, and a patient domestic investor base that bought all of it. That era is closing. In July 2026, the 10-year Japanese government bond touched 2.9%, the highest since 1996. And the money Japanese institutions used to send outward into American bonds is turning around and coming home. The world's most reliable lender is becoming a borrower who needs its own savings. So why keep issuing? Because for the institutions holding it, government debt is the safest collateral that exists. On their books, a treasury bond is the foundation stone. Pension funds hold it. Banks post it as security. Central banks treat it as almost money. The whole system depends on governments never clearing the balance. Because if Washington paid off every dollar tomorrow, the world's most trusted financial instrument would disappear overnight. The dollar supply would contract hard, and the scramble for a replacement could tip into deflations. So governments do the opposite. They issue more, not recklessly, but rhythmically, the way a shark keeps swimming to keep breathing. Debt has become the heartbeat of the system, pulsing through pensions, mortgages, and markets on every continent. When politicians promise to finally balance the budget, they're selling a story. The goal was never zero. The plan was never to pay it back. The plan is to keep the world believing it will, but belief is unevenly distributed, and so is the money. Interest payments flow upward, from taxpayers and wage earners toward whoever was already wealthy enough to own the bonds. Pension funds mean ordinary people sit on the creditor side too, just not in the same proportion. Sovereign debt moves money between classes as much as between countries, which is part of why global debt and global inequality keep climbing through the same decades. A country that borrows in its own currency can always print what it owes. Inflation becomes the tax nobody voted for. A country that borrows in someone else's currency gets no such escape, which is exactly what happened to Greece inside the euro and Sri Lanka in dollars. Even that isn't absolute. Russia defaulted on its own ruble debt in 1998. So the real line runs between borrowers who control the printing press and borrowers who don't. And Moody's warning was that even the safest borrower on earth is heading toward a debt around a third larger than its entire economy within a decade. Debt once meant bondage. Today it mostly means balance, a promise nobody intends to keep in full, and everybody needs kept alive. You didn't sign this, you're standing on it. More systems taken apart. Next. Quietly broke.